Welcome back to the deep dive. Today, we're really digging into what the Federal Reserve did back on October 29th of 2025.
Yeah, that meeting was definitely a big one, a real pivot point, you could say.
Absolutely. Two major shifts from the FOMC, adjusting the target rate, and maybe even more critically, setting a firm end date for winding down the balance sheet, that whole quantitative tightening thing.
Exactly. Ending a campaign that's been going on in various forms for a long time.
So our mission, like always, is to give you the quick route to understanding this. We want to cut through the Fed speak, figure out the why behind this decision, especially with those mixed economic signals.
And figure out what it means for you.
Right.
Whether you're borrowing, saving, investing. These shifts matter.
Precisely.
It's so important because these aren't just, dry reports. They show how the central bank sees the economy.
Right.
And when they move on to big fronts like rates and the balance sheet, well, they're signaling a pretty profound shift in how they view risk.
So we need to figure out what pushed them.
Yeah, what forced their hand.
Yeah. Okay, so let's unpack that. Before we even get to the headline rate cut, what was the economic situation they were looking at? What did the committee see heading into October?
Well, they described the economy as expanding, but clearly losing some steam.
Okay.
The official language was expanding at a moderate pace.
Moderate, that sounds okay, but not great.
Exactly. Comfortable, maybe, but definitely not signaling some strong boom. The real concern, though, seemed to be bubbling up in the labor market.
Ah, okay. Tell us about that, because that's half their mandate, right? Maximum employment.
That's right. And they specifically pointed out that job gains have slowed this year.
Slowed down.
Yeah. And even though the unemployment rate was still pretty low historically, they noted it had edged up through August.
So the direction was worrying them maybe more than the actual level?
I think that's a fair way to put it. A decelerating job market, and that trend line was likely causing some unease.
Okay, so that's the jobs picture. What about the other side of the coin? Inflation. Price stability, the 2% target. How did that fit in?
Well, that's where things get really tricky for policy.
Right.
They reported inflation had actually moved up since earlier in the year.
Moved up.
Yeah, and it remained, in their words, somewhat elevated.
So wait, slowing jobs but still elevated inflation? That sounds uncomfortable.
It's very uncomfortable, kind of like stagflation light maybe. Softening growth, job concerns, but prices are still sticky and high.
And that conflict forces a choice.
It forces a choice. They couldn't easily address both problems with the same tool.
Which brings us to why they acted. It wasn't just the data points, it was the risk assessment.
Exactly. This is really the key takeaway phrase from the announcement. The committee judged that downside risks to employment rose in recent months.
Okay, downside risks to employment.
That's the moment they decided. The danger of rising unemployment, maybe even a recession, started to outweigh the immediate problem of inflation being a bit too high.
They called it a shift in the balance of risks.
Right, which basically means, translating from Fed speak, they're now more worried about jobs than inflation, at least for the moment.
So they're willing to maybe tolerate inflation staying higher for longer?
If it means preventing the job market from really weakening badly,
Yes.
they tilted towards prioritizing jobs.
That translation is vital. They're making a trade-off. Okay, so that worry about jobs, how did it translate into the actual rate decision, the hard numbers?
Well, given that risk shift, the main action wasn't a huge surprise. They lowered the target range for the federal funds rate.
How much?
By 14 percentage points, just a standard quarter-point cut.
Okay, so the new target range is
3.34 to 4%.
3 3/4 to 4. So like you said, a measured cut, not a big half-point move suggesting panic, but a clear signal they're easing policy.
Definitely an easing signal. And they were careful in the statement to link it back to their goals.
Right, they always are.
They mentioned their strong commitment to both maximum employment and getting inflation back to 2% eventually.
But what about looking forward? Did they signal more cuts are definitely coming?
No. They stuck to the usual flexible guidance. They said they'll carefully assess incoming data, the evolving outlook, and the balance of risks.
Standard language.
Pretty standard. It basically means we cut this time because of the risks we see now, but don't assume this is the start of a long cutting cycle. We'll watch the data.
They keep your options open.
Always. They explicitly said they're prepared to adjust policy again if new risks pop up that could hinder their goals.
Okay, but this raises a really interesting point. Was everyone on the committee actually agreed on this pivot? The votes can tell you a lot about internal disagreements.
Oh, absolutely. The vote count is often where you see the real debate, and this decision passed 10-2.
10-2. Okay, so not unanimous. Who were the dissenters?
And this is fascinating. They were on completely opposite sides of the argument.
Really?
Yeah. First, you had Stephen Mirren. He actually wanted a bigger cut.
Bigger? How much bigger?
He preferred a half percentage point cut, 50 basis points.
Wow. Okay, so Moran must have seen those employment risks as much more immediate and serious. Wanted more stimulus faster.
That's the read. He was essentially saying, this isn't enough. We need to act more decisively now.
Okay. And the other dissenter?
Jeffrey Schmid. He was on the complete other end. He preferred no change to the target range at all.
No change. So he's clearly the inflation hawk in this scenario.
Has to be. Even with the softer job data, he must still see elevated inflation as the main threat that needs continued tight policy.
That 10-2 split with dissenters wanting more easing and no easing, that really highlights how tough this call was.
Really does. It shows the committee was genuinely grappling with those competing mandates. A clear majority felt easing was needed, but how much easing and the underlying risks still clearly debated internally.
Okay, let's shift gears slightly to the mechanics. The FOMC sets the target, but the Board of Governors actually implements it, right? Makes it happen in the money markets.
That's correct. They adjust the rates they control directly.
So what specific rates changed, effective October 30th, to get the market rate into that new 3.34 to 4% range?
Right. These were voted on unanimously by the board. Two key adjustments. First, the interest rate paid on reserve balances, the IORB rate.
Okay.
That was lowered to 3.90%.
3.90. And why is IORB so important?
Well, it basically acts as the floor for the federal funds rate. Banks generally won't lend reserves to each other overnight for less than they can get just parking them safely at the Fed.
So lower the IORB and you pull the market rate down.
Exactly. It helps drag the effective federal funds rate down into the target range.
Okay, so that's the floor. What about the ceiling of the range?
That's managed primarily through the primary credit rate, often called the discount rate, is the rate banks pay if they need to borrow directly from the Fed.
And that came down too.
Yes, also by a quarter point down to 4.0%.
Matching the top of the new target range.
Precisely. So that sets the effective ceiling. Those two moves together guide the overnight market rates into that new lower band.
Right. Now, let's tackle the second huge decision from that meeting, the one about the Fed's balance sheet, the SOMA portfolio. Quantitative tightening. What was the news there?
Yeah, this might actually be the bigger long-term story. It's a major policy shift. The committee decided to conclude the reduction of its aggregate securities holdings.
Concluded, meaning stop it.
Stop it completely. And they gave a date, December 1st.
December 1st. Wow, that's a very clear deadline.
A very clear, hard stop date for quantitative tightening.
So just to remind listeners, QT was the Fed letting bonds mature off its balance sheet without replacing them,
Right.
basically shrinking the money supply, pulling liquidity out.
Exactly right. It was a passive tightening mechanism, draining liquidity from the financial system.
And ending it means turning that drain off.
Completely off. After December 1st, the passive draining stops. This is a big deal, especially for markets like the Treasury market that have had to absorb a lot of new debt without the Fed consistently buying. It signals relief on the liquidity front.
Okay, so the shrinking stops December 1st. What happens after that date? How does the Fed manage the principal payments it receives from the bonds it still holds?
Yeah.
That reinvestment strategy is key, right?
It's absolutely key, and the change here is significant, both in terms of amount and what they buy.
Okay, break that down. What was happening before December 1st?
Up through October and November, they were still letting some bonds run off under caps. They let up to $5 billion a month in Treasuries mature without reinvestment,
Right.
and up to $35 billion a month in agency debt and mortgage-backed securities, MBS, run off. Any principal payments above those caps were reinvested, mostly into Treasuries.
Okay, so a capped runoff. What happens starting December 1st?
Those caps vanish. The new directive is, first for Treasury securities, roll over all principal payments at option.
All of them. So no more shrinking of the Treasury holdings. They maintain the size.
Exactly. They keep their Treasury portfolio stable.
Okay. And what about the agency debt and MBS, those mortgage-related bonds? How are those principal payments handled after December 1st? Because that seems like a strategic choice.
It is very strategic. Starting December 1st, the policy is to reinvest all principal payments from agency securities,
Okay, all of them.
specifically into Treasury bills, T-bills.
Ah, T-bills. Short-term government debt. Why the switch to only T-bills for those agency reinvestments? Why not more MBS or longer-term Treasuries?
Well, it achieves a couple things for the Fed. First, it continues their long-stated goal of gradually moving away from holding MBS, reducing their direct footprint in the mortgage market.
Okay, shifting away from housing support.
Right. But perhaps more importantly, from the Fed's own risk management perspective, reinvesting in T-bills significantly shortens the duration or interest rate sensitivity of their portfolio.
Ah, so it makes their balance sheet less vulnerable if rates were to unexpectedly rise again later.
Precisely. T-bills mature quickly, so their value doesn't fluctuate as much with rate changes compared to long-term bonds or MBS. It's a move to make their own holdings safer, more liquid, less risky.
That's a really important nuance. So they're ending the overall balance sheet shrinkage, providing liquidity relief, but simultaneously tweaking the composition to reduce their own internal risk.
You've got it. It's quite a tactical shift within the broader pivot.
Okay, so let's try and wrap this all up. We've got these two defining moves from the Fed in late October 2025. First, a quarter-point rate cut.
Driven explicitly by that shift in focus towards rising employment risks.
And second, a definitive end to the balance sheet runoff, the end of QT, scheduled for December 1st.
With a strategic shift to reinvesting agency paydowns into short-term T-bills.
What's the big message here? What does this all signal?
It signals the Fed has officially changed gears. They've decided the risk of an economic slowdown, maybe a sharp rise in unemployment, is now the bigger worry compared to inflation running somewhat hot.
So the rate cut is a gentle nudge on the accelerator.
And ending QT is like taking their foot completely off the liquidity brake. They're moving from tightening to, at the very least, neutral, possibly easing.
But that brings us back to that split vote, doesn't it? The dissent.
It really does. Because while the majority felt they had to ease due to job risks, you still had Jeffrey Schmid arguing for no change.
Right.
That tells you the fear of inflation flaring back up hasn't disappeared. It's still a potent concern within the committee.
So the provocative thought for you, the listener, might be this. They've made this trade-off, prioritizing jobs now. But what happens if inflation does re-accelerate down the line?
Exactly. If they have to keep cutting rates because the job market weakens further, will they have painted themselves into a corner if inflation surges again? Have they used up some of their credibility or firepower needed for that fight?
It's that constant tension of the dual mandate. The debate clearly isn't over, it's just shifted focus.
It absolutely has.
Understanding that December 1st balance sheet change, and particularly that move into T-bills, that's definitely something to keep an eye on as you think about markets heading into the new year.
For sure. It has real implications for liquidity and interest rates.
Thank you for joining us for this deep dive into the Fed's latest moves.